Good afternoon. This is Lance Bryce with Thrive Mortgage. Today is Thursday, the 25th of May. I hope you're doing well. We have seen rates increase every day for the last 2 weeks, y'all. We are sitting at a grim milestone. Mortgage News Daily has the national average at 7.120 today. 7.12, 7 1/8. Y'all, you have to go back, and I did the research. You have to go back to April 5th of 2002. You have to go back 22 years to find interest rates as high as they are now, the last time we were at this level. We have actually seen rates increase about 3/8 of a point in the last week. We were at 6.82 last Thursday. We were at 6.50 in that same average last month at this same time, 30 days ago. So what is adding to it, y'all? Everybody's seeing it in the headlines. The debate over the debt ceiling increase is weighing heavily on the markets. The possibility that our debt instruments would be downgraded and command a higher yield is weighing heavily on the markets, and you're seeing that yield incrementally priced into fixed income securities out of fear that that's where it's headed if we don't reach a deal on the debt ceiling debate. So I talked to a financial planner today that says he is hearing rumblings that there may be some ability to kick this can down the road a bit, to push this, to find ways to pay our bills until August or September through some sort of continuing resolutions that may get us there. I suspect we're going to reach some kind of accommodation before we go into a straight up default. We've never defaulted as a country. And frankly, understand that this is a political conversation that we're having. These are legal benchmarks that we have placed on ourselves as a country. This is not a situation like Greece a decade or so ago where they literally did not have the money to service their debt. Right now, the interest on the debt is costing us around 17% of our budget. We certainly have the revenue to service our debt. So this is not an issue of us being in financial default. This is an issue of us not having the political ability to get across the finish line and increase in the limit that we have imposed through law. So it is important, but y'all, I think it's an important distinction to know. We're not talking about the federal government being unable with our current $3.5 trillion of tax revenue to pay our bills. It certainly is able to pay our bills. So that being said, we're going to see a resolution at some point. We will see interest rates and this fear that has entered the market financially begin to pull itself out. We're seeing some interesting things, though, in the markets. We're seeing quite a bit of softness in the Dow. Folks are afraid to get into equities, and frankly, the bond yields are showing they're afraid to get into fixed incomes as well. And you are seeing some sectors, though, tech and specific, semiconductor stocks that are rallying strongly. It's almost as though semiconductors have become the new flight to safety because there is still such a shortage in supply. There is still such a huge increase in projected demand due to the prominence of AI taking force throughout the marketplace. So I think you're going to continue to see semiconductors benefit from that. So just an interesting tidbit, not giving financial advice there, although I have been happy to see those increase. That's where we are in the marketplace as of right now, y'all. High interest rates, still expecting them to come down. I still think we're going to see significant pressure downward once we get revisions to the CPI, the May revisions to CPI that come out in June. I think we're going to see that shelter cost component start to really make an impact in that headline number. And as that becomes more apparent, y'all, we're going to see further moderating language from the Fed, and I do think that we will see these rates come down. That said, we have broken through some key technical levels of support in our bond trading that affects our interest rates. So we're likely to see these rates head higher before they come back down again. And the timeline of them coming back down is not all that predictable, y'all. So we may well see rates knocking on the door of 7.5 before we start seeing any opportunity for them to come back down again. So short term, I'm encouraging my clients to lock the instant they have a contract on a house, to not put themselves at risk of what is likely to be further increases for the next 30 days or so. And then after that, who knows, y'all? We'll just have to see what the inflation data holds. In any event, I hope this information is helpful for you and for your clients. As always, I am here to visit with you about the market. I'm here to visit with your clients about how to strategize their planning for their future of buying a home. In any event, have a great week. Stay blessed. Stay safe. We will talk to you soon.